Nokia stock, under the ticker symbol NOK, is currently trading at exactly $13.83 on the New York Stock Exchange as we go through today's market session on Thursday, June 18th, 2026. Looking closer at the intraday data, the stock is seeing some short-term downward pressure, trading down by 1.07% as it slips for the second consecutive session after a historic, massive multi-month run. Right now, most people looking at Nokia stock on standard investing sites are checking out the basic chart, seeing the recent daily dip, and assuming this is just another slow-moving European legacy telecom company losing steam. But here is the massive development that the general market completely missing right now. Nokia is quietly attempting a total structural pivot away from slow telecom carrier spending and directly into the core of the global artificial intelligence infrastructure supply chain, backed by a major multi-billion-dollar partnership framework with none other than Nvidia stock itself. While retail investors are busy looking for the next hot software startup on a Robinhood app, institutional players are utilizing advanced trading platforms to load up on Nokia because of its critical control over optical networking and advanced photonic chip manufacturing. This hidden shift is creating a massive divergence between what the casual retail crowd expects from this stock and the cold, hard, fundamental reality that is playing out on the institutional order books. The common ground or general consensus surrounding Nokia has always been clear and frankly quite boring. For the past decade, if you brought up Nokia in a conversation about online investing or self-investing, people would look at you like you were trapped in the early 2000s. The collective market narrative was that Nokia was a dinosaur that missed the smartphone era, scrambled to find a footing in 5G mobile infrastructure, and was doomed to slow, low-margin growth while being squeezed by brutal international competition from companies like Ericsson. When people seek investment help or search for steady, long-term assets to place in a Schwab Intelligent Portfolios account or individual brokerage, Nokia is rarely the first name that comes up. The expectation was that it would remain a cyclical, dividend-paying value trap with flat revenue growth. But the reality we are seeing on the ground right now completely shatters that narrative. Nokia stock has completely outpaced the broader market over the past 6 months, surging over 150% from its late 2025 lows near $6.50 to a recent multi-year high near $15.78. This is not just a standard momentum bounce, it is a fundamental repricing of the entire company's equity value. The catalyst that changed everything occurred when Nvidia stock stepped in with a massive $1 billion investment in Nokia to build out AI RAN, a cutting-edge architecture that combines advanced artificial intelligence workloads directly with wireless network infrastructure. Suddenly, instead of just supplying standard radio antennas to cell phone carriers, Nokia became a primary co-developer of the infrastructure needed to process massive artificial intelligence data models at the edge of the network. This has completely shifted how professional portfolio managers on a Fidelity trading platform look at the stock, moving it from the forgotten telecom pile straight into the high-growth artificial intelligence data center bucket. When you break down the recent stock movement, trading volumes, and institutional activity over the past few weeks, you start to see the true tug-of-war between expectation and reality. After the massive run-up, we are seeing a minor 1 to 3% pullback over the last 2 sessions, which is entirely natural profit-taking as the market digests these massive gains ahead of the critical second quarter earnings report coming up in late July. Institutional data shows that trading volume spiked by over 170% compared to its 3-month average during the initial breakout, signaling that massive blocks of shares are moving from weak retail hands into large institutional funds. Large investment firms managing massive portfolios through Fidelity Investments, Fidelity Brokerage, or advanced interactive brokers trading systems are increasingly looking at Nokia as a significantly cheaper way to buy into the artificial intelligence infrastructure trade compared to buying astronomical valuation tech stocks that are currently trading at 50 or 60 times revenue. Even with the recent surge, Nokia's forward-looking valuation metrics are drawing immense attention from analysts who realize that the market is still pricing this company like a legacy hardware business, despite its high-margin software and optical infrastructure segments growing at a lightning-fast clip. Let us get into the numbers from the most recent first quarter earnings report because they tell the true story of this structural transformation. Nokia reported total revenue of 4.5 billion euros, showing a solid 4% year-over-year growth, but the real shocker that caught the market off guard was its comparable operating profit, which skyrocketed by 54% to 281 million euros. That kind of massive margin expansion doesn't happen in a stale legacy hardware business. It happened because Nokia sales to specialized cloud and artificial intelligence customers surged by a massive 49% in a single quarter. Hyperscalers and massive tech giants are aggressively building out massive data centers, and they are ordering Nokia optical networking equipment by the truckload, leading to over 1 billion euros in new cloud orders booked in Q1 alone. This caused management to instantly raise their full-year growth guidance for the optical and IP network segment to a range of 18 to 20%.
When you look at these metrics through an interactive broker's platform or track the fund flows through Fidelity mutual funds, it becomes blindingly obvious that Nokia is no longer just dependent on telecom providers cutting checks for 5G upgrades. To understand why this is happening, we have to look at the massive expansion Nokia just announced less than 48 hours ago. On June 16, 2026, Nokia announced a massive expansion of its advanced test and packaging operations in Allentown, Pennsylvania, a move specifically designed to bolster domestic U.S. manufacturing of photonic chips. They are investing around $30 million of their own capital, supported by federal CHIPS Act investment tax credits and state funding, to effectively double their local workforce and scale up production capacity at the site by up to 10 times current levels. Photonic chips use light instead of electricity to transfer data at ultra-high speeds with incredibly low power consumption, making them absolutely vital for next-generation artificial intelligence clusters that require massive bandwidth. By onshoring this critical part of the supply chain in the United States, Nokia is positioning itself as a trusted, secure, Western supplier of the exact hardware that tech giants need to keep their artificial intelligence models running without running into geopolitical or regulatory roadblocks. This is a massive competitive advantage over international rivals, and a primary reason why major brokerages have been aggressively upgrading the stock over the past 2 months. Comment below how many shares of Nokia stock you currently hold, or if you are using platforms like Robinhood app or Fidelity mobile app to trade it. Your insights help map out exactly what retail investors are doing while the institutions make their moves. Now, let us take a step back and examine what this company actually does at its core, its underlying business model, and how it arrived at this fascinating crossroads. Founded all the way back in 1865 as a simple Finnish paper mill, Nokia evolved over more than a century and a half through rubber boots, cables, and eventually into the absolute king of mobile phones in the late 1990s and early 2000s. After losing the smartphone era to Apple stock and Android devices, Nokia made the strategic decision to sell off its mobile handset business and focus entirely on network infrastructure, acquiring Alcatel-Lucent in 2016 and positioning itself alongside Ericsson and Huawei as the big three of global telecom hardware. Its traditional business model relies on selling hardware, routing equipment, and software licenses to major telecommunications providers around the globe, generating massive but cyclical revenues that are heavily dependent on when these massive telecom giants decide to upgrade their nationwide networks from 3G to 4G and then to 5G. The main issue with this legacy model, and the reason the stock languished for nearly a decade, is that once a massive rollout cycle like 5G concludes, telecom providers rapidly scale back their capital expenditures, leaving infrastructure providers with flat revenues and compressing margins. This brings us to the future outlook, where the entire investment thesis for Nokia stock rests on whether its new artificial intelligence data center business can permanently offset the ongoing cyclical weakness in its legacy telecom segment. There are two highly distinct future scenarios that could play out from here, and both are tied to the concept of expectation versus reality. In the bullish scenario, Nokia successfully transitions into a dominant player in the data center switching and optical transport market, riding the coattails of the broader spending boom where cloud giants are projected to spend hundreds of billions on physical infrastructure. If their AI RAN platform, which already has major public commitments and active partnerships with global operators like T-Mobile, SoftBank, and Deutsche Telekom, passes its field trials later this year, Nokia could unlock a massive recurring software revenue stream that the market currently hasn't priced in at all. This would completely justify the current stock price and drive it well past its previous highs, as the reality of their earnings power completely blows away the historical low growth expectations. Conversely, the bearish scenario is where the artificial intelligence infrastructure spending cycle cools down faster than expected, or where intense competition from established data center giants like Arista Networks limits Nokia's ability to capture meaningful market share outside of its core telecom base. If telecom operators find that the economics of upgrading to AI RAN do not provide an immediate return on investment, they may delay these rollouts, leaving Nokia exposed to its legacy business, where provider revenues recently dipped by 2% year over year. Furthermore, because the stock has run up so quickly over the past 6 months, any sign of execution delay or a miss in the upcoming July earnings report could cause short-term traders using Robinhood stock trading or active interactive brokers account systems to rapidly unwind their positions, leading to a sharp correction down toward key moving averages. Investors must weigh these real execution risks against the undeniable structural tailwinds the company is experiencing. To tie everything together, Nokia represents one of the most compelling examples of a stock caught between an outdated market expectation and a rapidly accelerating fundamental reality. The old expectation was a stagnant telecom hardware provider trapped in a slow growth cycle with zero sex appeal for modern online investing strategies. The real-world reality is a company that has effectively integrated itself into the high-margin, high-growth hardware requirements of the global artificial intelligence infrastructure boom, earning the validation of a massive billion-dollar partnership with top-tier chip makers and rapidly expanding its advanced domestic manufacturing capacity in the United States. While the daily fluctuations and short-term ticks on the Fidelity trading platform or your tracking apps might show minor consolidation after a massive 150% rally, the deeper institutional trend shows a profound reevaluation of what this company is worth. As we move closer to the pivotal late July earnings release and the subsequent field trials later this year, the market will finally have to reconcile its old memories of Nokia with the powerhouse infrastructure player it is actively becoming today.